Ooh, it's chilly. Hello, Bitcoin traders. Welcome back for another episode of Technical Analysis on the Daily with me, your friend Rocky Outcrop. And look at that background video. Isn't it so chilly and spectacular? It's quite amazing, in fact, what people are willing to put out on the internet for free, isn't it? Like and subscribe. This is great content. I do it every day. And ooh, this might have been us last night. The moon. Was that you? Was that you last night, staring at the charts, thinking about the moon? Well, I wonder. And look, there's me in the background, Rocky Outcrop. Don't I look majestic in this video? I really do. Well done to the guys that made it. Hats off to them, of course. Attributations. I've linked to the creators of this video in the description below because it's Creative Commons. Okay, let's just dive on into the charts, take a look at what's going on. Okay, welcome back to the charts. Thank you very much for sticking through the intro music. And my name is Rocky Outcrop. I am not a financial advisor, and none of this is financial advice. It's probably a good job that I say that from time to time just to remind everybody. Okay, so here we are, and we're looking at the daily chart. This is Bitcoin versus the US dollar on the 24-hour time frame, and it's the information's coming from Bitstamp, and of course, this is TradingView that we're looking at here. And let's just have a wee look at the highs and the lows. Can't remember which way to look. I'll try this way. The lows of 9,215 and highs of 9,429. Well, in the 24-hour time, that doesn't seem like an awfully big range. It's really more like if you were to look at over the last 48 hours. And let's just kind of do that ourselves manually. We've come up from around the 8,800 or so levels up to the 9,400 or so levels, and that was quite a significant price point to be breaking through. In yesterday's video, we asked, will we try for a higher angle, or will we just triangle? So the question was really, are we going to consolidate around about the 200 simple moving, or are we just going to bust right through it and do that elsewhere? Well, it looks like we did indeed try for higher, and that's great. We were cautious yesterday about shorting. Cautious, by cautious I mean I said I wouldn't be taking a short here, and we were really just looking at where we'd want to get in our longs for today. Now, is it the same story today, or could we be looking at something a little bit different? Well, I would want to introduce a little bit more caution into today, just because, well, we've done a couple of things that are worth pointing out. For instance, as you can see right there, on the daily chart, we broke right through the 200 simple. And what is so very common when you do this sort of thing, of course, it may not happen today, it may not happen tomorrow, but it'll happen. It should happen at some point in the near future. You would come back to test this as support, which was previously resistance. Indeed, you can see here on the way down how we broke it as support and then retested it as resistance. Well, likewise here, we broke it as resistance, we tested it as support, ultimately it failed, and you would expect the same sort of thing to happen. Now, I don't want to spend too long on this simple point because that really does cover it right there, but I suppose I can look here and just point out that, in fact, there are occasions when you break above the 200 and you don't really come back to test it for quite some time. So it's worth pointing this out as well, that indeed it may not actually happen at all. But there are plenty of other things to be looking out for in the meantime. And as you can see quite clearly here, the 10 simple and the 21 exponential moving averages, of course the 200 simple being this white dotted line, the 10 simple being the red dotted line there, and the 21 exponential moving average being that yellow line there, they frequently get tested again. And where are they currently at the minute? Well, they're both below the 200 simple on this current time frame, whereas when we broke through it before, in fact, they were both below then too. Sorry, but they came down to test it again. So it's not a whereas, but it's just a sort of something to bear in mind over the coming days to temper any enthusiasm that you may have in the markets. And temper is probably quite a good word. When you temper something, you put it through a process which builds up resilience inside whatever it happens to be, and it's able to withstand something happening to it. And the price does need to be tempered somewhat after having broken through this 200 simple moving average. And I think that's probably a good word to sum up what we're looking at right now. Now, I think we'll just jump over to the CME charts to point out this little funny thing here. It's always worth looking at the nuances. And this is the 24-hour chart, and indeed, on the spot prices last night, as I was saying with that video, it depends if you were watching it at all or not at the time, but if you were tuned in around to the charts around midnight GMT, 11 p.m., that sort of thing, you'll have seen the price rise up. So it was actually the spot prices that carried us up to where we are now, which is interesting because the CMEs certainly have the power and the mindset, you could say, to lead the market more than the spot prices do. Now, it's kind of a funny statement, that, but this goes back to what I was saying in a few videos ago about how pricing of anything is actually determined. And, well, the CMEs, they're a futures contract, and they help people determine the price of what Bitcoin should be a lot. And they've got a lot of weight to them. A lot of professionals use that, and there's a lot of institutional money there. So they has a lot more weight in the market compared to just any given random spot exchange out there. For instance, you could say that the CMEs have got as much strength in the market as, say, Coinbase and Bitstamp and all those ones, got more, as much or more than them. And when it's not leading the market, then it's always worth looking to see what the differential is between there and take a look at the delta. And the delta here is shown in this gap where we have 9,215 up to 9,250. So there's a gap on the daily chart, which is interesting because normally those happen during the weekend. Well, there's more opportunity for those to happen during the weekend, such as this one, where we had a gap here of $35 or so down at 8,500 or so level. Now, these gaps do tend to get filled. That's just traditionally what we've seen happen over the course of history with this asset using this market. They do tend to get filled. And it's interesting to see that there's one here which could potentially get filled at some point, and there's also now one here which also could potentially get filled at some point. And how would that really translate back over to the spot prices should the CMEs decide to take the reins again? Now, as well, it's worth mentioning that the CMEs could go ahead and fill their gap without really affecting the spot markets too much. Part of the reason for that, of course, is that there's a 15-minute delay on the CME prices, so a lot of retail investors out there can't track the prices in real time. That's one of the reasons. There's plenty of reasons. But it could happen independently, so to speak. Now, what we'll be looking at here is just in that. I like to keep things quite simple, really, but when you're in an uptrend, you like to make higher highs and higher lows. And what we've done here, well, we've made a higher high. So you would expect either for the price to continue on or for us to potentially put in a higher low. And there certainly are areas of interest. You can see on the daily chart here, the 200 simple comes down, an area where you could very easily go down and test it, and it would very much be a higher low. But indeed, the 10 simple there currently right now is also in an area where it would be a higher low, and the 21 moving average, exponential moving average, is also in an area where there'd be a higher low. In fact, the chances are that by the time we're even setting in a higher low, the 200 exponential moving average will also be in around that area. But bringing that up, there's also something else to point out currently. Now, these are all things which are relatively bullish overall. You know, it's healthy to set in higher lows. So when I'm talking about the price potentially coming down here, indeed, there's a few $100s there. You could absolutely tradable moves, absolutely. However, and of course, I'd be far more happy to be opening up shorts at this level than I would have been in and around this level. Hence why I said not to in the previous video. But you know, there's this really worth pointing out in terms of bullishness. Of course, that would be healthy. What I'm saying is if it's set a higher low. Bullishness is that we're approaching a golden cross on the exponential moving averages on the daily time frame. Now, of course, the classic definition of a golden cross is the 50 simple moving average crossing over the 200 simple moving averages. And if you've been watching along with my videos, you'll know that this green line is actually the 55 exponential moving average, and that is the 200 exponential moving average. So, not actually the ones which are from the rule book, but that's besides the point. Really, what we're looking at here is just how this is a positive sign in terms of the trend. And of course, the trend has been ongoing for the last, well, over a month now. The trend has been on to the upside. So This here is more of a signifier or an analog of past historical data. So when this crosses over, the reason why it'll cross over will be due to the trend which has been ongoing for a while. And if they cross over, you could say that the strength of the trend is potentially enhanced by this crossover. Now, maybe you might be interested in knowing where the 200 simple actually is currently then, and I can quite simply show you that by changing over my 10 to 50. Where it would be on the moving averages, on the simple moving averages, where a golden cross would be. Well, you can see that it's some ways away there. Look, the 50 moving average on the simple is very much quite low down. It's below all of these other averages there, and it has been quite a while since they crossed. And indeed, where they crossed to the downside was over here. It was over here after this explosive move above the 200 simple in the past, and that would have been a good thing to keep an eye on there and say, well, hey, let's be cautious about this upward move, because we have just actually experienced at the same time a death cross on the daily chart. Now, if you were watching the charts back then, you might not have been aware of that. And why am I pointing that out today? Well, that's not the case. They are actually converging, even though that's as wide as a whale's mouth right now. So I wouldn't actually, you could fit a lot of sandwiches in that gap. But but they are actually coming closer together, and at some point in the future, possibly 50, 100 days away, you could see these things getting closer together. But currently, of course, they're quite some distance away, and really, I find that if I'm going to have that on the charts, I'll just keep it as the 10, because as you can see, it's more, generally speaking, more useful in the short term. But I just wanted to point that out so you know where we stand on that front, okay? And let's just take a quick look at the weekly, because the weekly has been an interesting chart for us in terms of seeing the Fibonacci retracements, because the Fibonacci retracement from the June move down to the tippity top of this head and shoulders here in December, inverse head and shoulders in December, of course it doesn't really look like one of the weekly, but what are you going to do? It's easier to see those lines and the numbers and everything else on the weekly than it is on the daily chart. And also what we're really trying to keep an eye out for on the weekly for overall turnaround and the trend, really, the first big pat on the back we'll give ourselves and the Bitcoin bulls will be in around this 9,500 and whatnot level. So you choose your own particular number, but of course 8,500 and 50 is an easy way to say that. So we'd really be wanting to open and close above that. And why is that worth pointing out? Well, it happens to be between these 2 points on the Fibonacci retracement of the 382 and the 50%. And of course, the 382, 50, and 618 are the 3 major profit-taking zones if this was to just simply be a retracement of a downward move, which would then continue to go downward afterwards, or indeed, if indeed it were to continue to go up, you would have lots of profit-taking happening at these zones here, all 3 of these. And where are we right now? Well, we're right on the first one. And we've been here before. Close enough is close enough. You'll remember me saying very many times a couple of weeks ago when we got up to it the first time around. Well, this time we've come up with certainly a lot more gusto than we did that time. And the body of this candle over the last week has been much more positive, or during this week, sorry, than it was in the previous ones in terms of reaching this with a bit more sort of momentum behind us. Now, the oscillators down below are also kind of indicative of that. If you look back here, you can see that they've just crossed over and we just moved out of the neutral or the bearish zone into the neutral zone on the oscillators down below. And when we were coming up the first time and being resisted at the 21, before then we went on to be supported by the 21 on the weekly. And at the minute then, you've actually got a more upward sloping and more positive looking set of oscillators down below on the weekly. So that's than it was then. So you'd have more optimism about the momentum coming into this here, and from that sort of viewpoint than you would have previously. So what we did expect was to come up, test it, be rejected by it, and then come up and try again. That's totally natural, and that's what we've done so far. So the question really becomes, will we be consolidating in this area? The question I posed yesterday is again the question for today. Will we actually try higher and try and go for any of these other ones and break above all this resistance or whatever? Or will we actually consolidate around here in order to give ourselves and the oscillators and everything else enough time to refueling, recharging of our batteries to be able to go up there and do it and actually break through that area on the longer term. So that's kind of what we're looking at the minute, where we're looking. We've got the golden cross coming up on the spot prices, and in fact, it's probably worth pointing out how they have indeed crossed on the CME chart. But the CME chart has been somewhat, if you want to look at it as like leading the market, I mean, you can see here we were above the 200 simple for a while a couple of weeks ago, and you just saw in the spot markets how we came up and tested that, whereas on CMEs we're up above and living above. So the pricing being ever so slightly different results in these moving averages being in ever so slightly different places, and which results in the supports and resistances offered up by them in terms of the psychology of them being in ever so slightly different places as well. So the CMEs are already setting that in there. They've already crossed over, which is good news for the longer term. But of course, this can stay this way. This can stay this way so long as the prices really are above these moving averages. So what are we looking at then in terms of that? Well, you could have the prices come right the way back down and fill this gap, and these would not uncross. In fact, they'd only just continue to be looking more crossed than they were before, even more set in stone. So there certainly is room for a higher low, and there's the other gap there. It's not much of a gap, but it is ever slightly there. I mean, I don't know if you really need me, if you need me to zoom in a bit, so that there you can see the gap there with your eyes. So that's what we're looking at the minute. Will we be seeing these things be filled or not? You know, they can happily sit there for quite some time. There's a gap to the top side in and around 11,000 something. They can't really. There's not much value in going looking for that at the minute, but there is something up there in the 11,000s, another gap similar to this, which will also be filled at some point in the future, you know, and you have to be patient sometimes for these things to happen. This gap here, which was quite a big one, was filled about a week later with a big shocking move down, all the way down to the 200 exponential moving average, and right back up again with $1,000 or so in that one day. Just, you could almost have said, just in order to get that done. And it didn't really affect where the prices were, although, of course, actually the prices were actually inevitably going down at that point anyway. So there's other ones as well. You can see this here is just filled by a wick the next day, stuff like that. This one here, this gap here is filled by a big red candle down, a big green candle the next day during this sort of choppy period as we broke through, as we came up and set in that high in June of last year. Okay, so I think that more or less wraps up where we are, and we can finish off by taking a look at the oscillators down below for any sort of signs of divergences that there could be getting set in at the minute. Of course, divergences are just warning signs. They're not, you need to find that and play it with confluence for other things, because as you can see on the daily, for instance, you know, you could have bearish divergence here. This is on the CME chart. I prefer to look at this on the spot chart, sorry. There was bearish divergence still on that at the time, but anyway, you can see it here. And we're continuing to go higher. There's bearish divergence here, here, and here on the daily from over here, and that was fairly significant, yet we're continuing to go higher. So it's just warning signs that we're looking out for. And of course, equally hidden divergences which signal continuation, they're also not set in stone. They're also what would you say the opposite of a warning sign is? A vote of confidence. They're just votes of confidence, okay? Right, so there we are on that front. So I've made that point. So let's just look for any on the lower time frames, just so we can get an idea of where the price might be going over the next day or so, if there's anything jumping out at us here. And you can see that this was an uptrend, and here would be the low of that there to draw some comparisons between. And well, there ain't nothing going on there on the lows in order to signify, pardon me, hidden bullish divergence on this time frame. There is actually touches of it on other time frames, as I pointed out in yesterday's video. Some hidden bullish divergence, although I wouldn't write home about it. And in terms of the top sides, of course, well, is that divergent? No, that's convergent. But they do have these 2 points here, and you could say that between these 2 points here, I will just make it big, and this point here and this point here on all three of the oscillators, that there is indeed on the 4-hour chart a degree of divergence. So see that's there. They're either exactly the same height or just a couple of butts below. I think it's ever just slightly below there. So that's classic class A bearish divergence, right? So that would put pressure or be a warning to us for for more continuation just yet before we actually sit in that higher low in terms of the 4 hour. And you can see that there, and there across the stochastics, RSI, and MACD. Now, if we just go over to something like the 1 hour, you'll see that again reflected even more obviously. So you can see between this point here, in fact, sorry, between this point here, this point here, and this point here, and possibly there, you've got classic divergence across the board yet again, okay? Or actually, apart from the MACD, which is ever so slightly, let's just bring it up to full screen so we can see. Well, it's been trending up here, so there's no divergences here. It's just on this point here, which could potentially be divergent, which is from over here. So you could say that from this area here, and this is of course the 1 hour chart. So it really, you know, you really are getting down to splitting hairs when you look at things like this. And let's just take a wee brief look at the 50 minutes for the crack, even though it is indeed like crack, this chart, and you should try and avoid smoking too much of it. So what are we looking at here? Well, noise, lots of noise, but you can see all the way down here, trending down the way, is that's kind of double toppy, you could say there. So maybe we're getting a sort of double top on the 15-minute chart, which could lead to setting in a higher low. But then have we done that already with this? And you could say so at the 9,200 level. I don't really know. I'll return to the 24-hour and say cheerio. So what we're looking at first off anyway is, can this level here hold? Right now we're testing it more or less with the 236. Sorry, got that wrong. The 382. Sorry, misspoke. Excuse me. The first of our sort of profit taking zones, and the question is, can we hold that, or will we go in and set a higher low, which would be healthy? Before I would actually turn bearish, I mean, what would it take for me to turn bearish? I would have to have the prices come back down here, break down there, go down even further, and then back down to this area here, where we'd have a lower low. So we'd probably currently, to sum that up, you could say to break down below and actually open and close below the 200 simple or exponential moving average would make me turn bearish again on a longer term viewpoint. And of course, the trend is your friend until the end of the trend. And that would coincide, if that were to happen, with this cross being prevented on the spot prices. But indeed, it has happened on the CME charts already, and that's worth pointing out there. There isn't an awful lot to be said in terms of anything else, to be perfectly honest with you. The charts aren't exactly predictive anyway. It's always a case of just trying to interpret the data yourself. But what can we see here overall is that in terms of volume and things like that is nothing really to be written about. We had the three white soldiers here, the three, you could call them, people call this three white soldiers. This candle, this candle, this candle is a classic charting pattern, three white soldiers. And what do you quite often see after you have three white soldiers? Well, soldiers, is that you do have a retracement down at some point and you set in that higher low. That's just typically what happens after you get them. Otherwise, you'd be talking about four white soldiers or five white soldiers or whatever. And if you're confused what I'm talking about there, that's three white crows or three white doves, the inverse of three black crows, whatever. They're fairly rudimentary charting pattern, which is, simple but effective. Okay, so we've had that, and I think that there's a good chance that we could come down and test off of this 200 simple moving average, but it's really a question of where that actually ends up being when we do that. And that's that for today. Well, thank you so much, and I hope you enjoy any moon staring that you're doing. Any moon staring that you're doing over the coming days. That was quite a beautiful video that those guys made, and they're very good of them to put that up for free on the Creative Commons, which I've taken advantage of today in this video which I make. And please like and subscribe if you want to see more of this. I make these videos on a daily basis. Every day I'm posting a new one, and I hope to keep you up to speed with what's going on in the market. Thanks so much for tuning in. I'll see you tomorrow.